Hi and welcome to Swissquote's Daily Market Talk. It's November 21st. The market went from euphoria to full-blown drama in a matter of hours yesterday after investors started digging into Nvidia's books and put also more pressure on credit risk across the technology bros. Oracle, SoftBank, CoreWeave saw their CDS levels spike again. Futures are calmer this morning and Japanese yields have eased in Japan from top levels, but fading hope that Nvidia would reverse sentiment this week after its earnings and waning expectations for a December rate cut from the Fed leave investors with little to hold on as we are coming toward the end of a hectic trading week. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. Whoa. Yesterday was something, wasn't it? We were happily sitting here and watching Nvidia save the market after announcing another round of impressive quarterly results the night before. And all of a sudden, shortly after the US opening bell yesterday, the mood started souring and things got downhill from there. Nasdaq, that jump-started the day 2% higher, finished the same day nearly 2.5% lower. Now, most of the news will say that the AI spending and credit worries resurface, which is true. Oracle, for example, which is the latest VIP member of OpenAI's mega deal circle, has now become the bellwether, the barometer of the AI credit risk, partly because it's spending billions of US dollars financed by debt, and partly because it has weaker credit grades compared to your Microsoft or Google. So Oracle saw its 5-year CDS spike past the 110 points yesterday, the highest in 3 years. CDS standing for Credit Default Swaps. It is an instrument that investors buy to hedge themselves against the risk of default of a company and or a government. The higher the perceived risk of default from investors, the higher the demand for hedging, and the higher the demand for hedging, the higher the price. So I don't want to bring this up and again, but Credit Suisse's fall had started in the CDS market, remember? I remember that a friend from London had just called me to tell me on a Sunday night that it was looking bad for Credit Suisse. And you know what happened next, to say it could go fast and far. Now, I'm not saying that this is where we will be ending, but coming back to why the market sentiment turned from euphoria to drama yesterday. Well, a few reports and analysis about Nvidia's own books actually started flowing in during the day, suggesting unease regarding two pressure points: its swelling inventories and unusual patterns in deferred revenue. Indeed, people started pointing out that Nvidia has built up large stockpiles of chips, partly because demand is shifting toward its next generation Blackwell platform, and partly because US export controls have left billions worth of H20 chips potentially never sold to the Chinese, forcing the company to book a multi-billion-dollar write-down. At the same time, it has been flagged that Nvidia has been taking in hefty prepayments from customers and then recognizing those payments as revenue too quickly before the chips were even delivered. Now, this is not illegal, mind you. It is a practice that could flatter near-term results but could leave a gap if future orders slow. And Nvidia may have done it to just smooth out an avalanche of revenue that it expects to flow from these Blackwell chip sales this year and next. Remember, Huang was talking about 500 billion US dollar worth of sales for this year and the next. But together, the inventory overhang and the fast cycling deferred revenue fueled concerns among investors that some of Nvidia's blockbuster growth may actually be front-loaded, with future quarters looking more exposed than the headline suggests. Now, when you dig deeper, you generally find dirt, know better what we are talking about. And the truth is, people start digging when they start feeling uncomfortable. And the level of discomfort that we are seeing today in the market is rising. The market opinions become, well, increasingly polarized between those who scream that this is a bubble and others willing to keep running. So I believe that this situation will lead to a heightened volatility across the financial markets and potentially big moves into the year end. It will be so much fun. Even more fun as the delayed data out of the United States looks mixed and somehow confusing. The September jobs data from the US that was released yesterday was not only old and dusty, but also somehow mixed. As I said, the report suggested that the US economy added nearly 120,000 new non-farm jobs in September. That's way above the 53,000 expected by analysts. And a separate weekly report showed that the jobless claims fell to 220,000, all unexpectedly strong. That was a part of the glass half full. But then, the uptick in the unemployment rate to 4.4% and slowing wages were the part of the jobs report that looked half empty depending on whom, obviously, because the soft US data is good for fueling the Federal Reserve does, hence more often good rather than bad for lifting risk appetite. But it didn't yesterday. The AI worries and Nvidia rumors kept the upper hand. The sharp decline that we saw in the US 2-year yield and an improved chance of a December rate cut from the Fed couldn't talk the bulls in. Good news is the Japanese yields are down from peak levels this morning in Japan. But it was hard to crack a smile out of SoftBank this morning in any way. The shares tanked more than 10% today alone and are down by almost 40% since their October peak. Some also point out that the crash that we see in cryptocurrency prices today may be also forcing investors to liquidate their other positions and likely their technology bets. So Bitcoin is testing the $86,000 level to the downside at the time I'm talking here this morning. And to be fair, there is nothing that could stop the fall given that we have no idea whatsoever how much a coin is worth other than the value that we are willing to give to it. So the week will probably end in a worse dilemma than where it started. Nvidia couldn't save the market. The Federal Reserve is still expected not to cut the interest rates in December, with a higher probability given to that scenario than a rate cut scenario. Japanese yields kept pushing higher this week, and the Japanese 10-year yield surpassed a critical level thought to trigger Japanese repatriation back home. That's roughly 3.4 trillion US dollars in overseas assets held by the Japanese investors, from US treasuries to technology and EM, that could, in theory, be pulled back home to Japan if domestic yields there climb further. So the bubble talk is bubbling everywhere. The valuations are high and the problem diggers are out digging for problems. Now, no one can tell you if and when the balloon would burst and who will take the hit, and there is no guarantee whatsoever that the history will be repeating itself. Yet the comparison of today's prices to past cycles is always interesting to watch. So this is how we are going to close this hectic week. I just found this chart of Nasdaq, gold, and Japanese assets showing similar price trends compared with the dot-com bubble, the gold boom of 1976 to 1982, and the Japanese bubble between 1986 to 1992. And the chart shows that today's prices are not even halfway through the past peak levels. Again, I can't and no one can tell you that this is going to be the dot-com bubble 2.0 or Japanese asset bubble 2.0, but if history is any guidance, bubbles tend to inflate way beyond what reason will tell. Remember, a financial bubble is not a bubble until it bursts. On this note, I will be leaving it here for this week of twists and turns and wish you a happy weekend. I'm İpek Özkardeşkaya. Thank you for watching and thank you for joining me. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. As usual, follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos if you like them to let us know. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.